No David Hunter type melt up for the S&P to 6,000 in the first half of 2024. It's now January 4th, 2024, and although we do agree the market is going up into April, we don't expect to see that kind of a rise that soon. We've been saying for some time the rally that started in October was very, very bullish and was a precursor of higher prices. And indeed, the higher prices exceeded even our expectations as it went higher all the way through December. And here is an important point. I can be wrong. It's also true that we expected a rally the last week of December, and we were correct about that. But then I framed it as if there would be a high the first week of January. And it turns out the high came in on the 29th of December, and it started to go down directly on January 2nd. Now, the correction is likely to continue until the mid to late February timeframe. And at this point, these are some price levels that are likely to be targets for the S&P during that time period. The 50% point would be 45.08 on the S&P, and it could go slightly higher. However, we don't know for sure if that's going to happen all in January or if it's going to be divided into an ABC format in February. As an analog that's repeating quite well is 24 years ago, the year 2000, the 30th of December was a high, and the market started exactly the same way we did this year. It had 3 down days in a row, and then the next step was actually a bounce. The rally went up until the 16th, until the 20th, between the 16th and the 20th of January, made a secondary high, and then worked its way lower until the end of January. Something similar to that is likely to happen right now. Even though we did go down, we didn't go down very much, and there's a very good chance the next 2 to 3 weeks we're going to see a potentially even reasonably strong rally before going lower into late January. Now, if you look at the year 2000, again, there was a high early February, came out February 4th, and a low late February, the 28th of February, completing the ABC correction at that time, and that was a fairly significant correction, which would take us down to the 4,400 area. If indeed that repeats. Another candidate which is extremely similar, also a multiple of the Jupiter cycle, the 12-year cycle, was 1953. And that one had a low early January and had a high early February and another low mid-February before it finished its decline phase and then rallied again. So we're looking for a 3-wave decline with a potential rally coming soon, even possibly a new high between now and the 20th of January. So don't get too attached to the short position without being careful about placing your stops, because on the way down, it could have some decent rallies. Even the one in the year 2000 had stair-stepped its way down with decent rallies in between. It was not straight down by any means. Then, after the decline in February, we expect a rally up into mid-March, probably into April, which is exactly what happened in the year 2000, exactly what happened in 1953, and we're likely to see such a thing happen again. Now, this is based upon patterns of the past. Looking at our internal cycles, looking at the cycles generated by the short-term influences that are happening right now, we are also projecting a March 15th high using a 240-minute S&P chart, and another variation on that, which is slightly more than 2 years, projecting for a similar March high, April high, and June low. So the first half of the year, we're looking for a couple of months down, a couple of months up into April, and then a big decline starting in April going down into June or July of 2024. That takes care of the first 6 months. But what's the big picture? Well, if you look at the large cycles, the main driving cycle in the S&P has been for a long time, the 60-year cycle. Basically, you have a picture of a market that goes up into 2025 before it's ready to come down. And that conceivably could happen again. And if you look at 2 times that, which is actually a little bit less than that, 119 years ago, is repeating quite well, it reinforces the same story, a high in 2025 and then a decline into 2026. 2026 being the bear market year, the one that most extreme decline will take place. So what happens between June of this year and the end of the year? Most of the patterns and most of the cycles are bullish. indicating the second half of this year, after June and potentially July low, we should see a rally until the end of the year into December, okay? Which means this is not a bearish year. It deviates slightly from the 24-year cycle where there was a high in September and the market started to collapse from September on. This one indicates that the probabilities are that we'll have strength later in the year, even after the election, until December of 2024, before any significant break would take place. So our overarching story is 3 basic moves. Down the first few months, up until April, down hard until June, July, and then the second half of the year is strong until the end of the year, December. And that's our forecast for 2024. The context, however, needs to be seen, because this context is that we're in potentially a longer up move, a longer term up move that continues into 2025, reinforced by several different cycles, including several that are happening right now. Right now we see a 252-week cycle is repeating. You can see it in this chart. There's also a 157 or 3-year cycle repeating. You can see it in this chart. In each case, both of those markets go up into December. And there's also a 188-week cycle. All 3 are bullish, and the 188-week cycle is bullish until August of 2025. So there's enough bullish influences here to keep this market up well past the end of 2024, okay? Now, the super bears who are looking for a huge decline in 2024, we do not agree that will happen. We think there will be a high in April, possibly a significant break for a few months into June, and possibly into July, but the second half of the year will be much more bullish than those people are anticipating. We're also anticipating potentially the market will hold up into 2025, because if you look closely at the 2000 market, even though we had a bear market starting in 2000 into 2001, 2002, which could be a candidate for repetition, it really didn't get going until May of 2001. So it went down after September of 2000 into February of 2001, but it rallied back strongly into May of 2001, which would line up with a high in May of 2025, even if that market did repeat exactly. All right, so what are the price projections on the downside? Well, we've already shown you where we're looking for support levels between 2,400 and 2,500, but we're also looking for the possibility, and we won't know this until we see how strong the market is in April, but if the market stays within bounds, stays under 5,000 or be under 5,200 by April, then there's a good chance that the super bullish scenario will not take place. The timing will be the same, and our work is primarily based on timing. But the David Hunter type suggestion for 6,000 or 7,000 in the S&P by second or third quarter this year, it would have to show up very soon, and the timing would still be the same. We'd be looking for a sideways market in the super bullish case between January and February, and a rally into April, May, which would be dramatic, rather than the rally that we're expecting, which is big but not huge, okay? So it's all contextual, and we'll see how the context unfolds. The timing's the same. First 2 months are bearish, the next 2 to 3 months are bullish, the next 2 to 3 months are bearish, and then the second half of the year, we're still looking for a rally till year end or close to year end, okay? Now, if you look closely at our matrix, which is our price matrix, which is a great tool that we've been using to anticipate price and also to time various events. Right now, the matrix is in between 2 clusters. Usually when it goes from one cluster, it goes down to the next cluster, breaks above one cluster, it goes above to the next cluster. In this case, it did break below the most recent cluster, and it had some trouble, as usual, jingle-jangling around between those price levels. And the next support level is in the low 4620s for support of the next cluster. And then it goes into there and has to start fighting its way. It does not mean, however, that the market can't rally immediately and go back up into the high end of that cluster in the 4870 area before going down in the February decline. So at this point, we think the correction has started. The correction will continue till February. There could be even potentially one nice rally starting this week as late, it could start as late as Monday or Tuesday of next week, but very soon get a rally up at least to the 16th and potentially till the end of the month of February before coming down for the C wave that will complete the decline. I want you to realize that this is not a precise trading system with specific buy and sell recommendations at particular prices. The primary focus that we have in these videos is on the intermediate and on the longer term trends. We're going to make our best efforts in doing the short-term analysis and forecasting, but the short-term cycles are much more complex and they can be off by a day or two, and in the short term that could mean a lot. So it is important to realize you have to be willing to take responsibility for whatever trades that you take based upon the information that you're hearing, because the information will not be that exact, and yet for the most part we're expecting it should be helpful in terms of giving you a heads up about the general direction of the trends.